The Financial Conduct Authority is proposing to increase transparency by naming firms under investigation. This is proving controversial amongst the financial services industry. They're claiming that they shouldn't be named when being investigated, that the principle of innocent until proven guilty should apply. They've labelled it being named and shamed, which makes it sound like innocent companies are being unfairly affected. Jeremy Hunt has taken the side of the financial services industry, saying that the FCA should not be naming and shaming businesses under investigation. Just a minute, who said anything about shaming? The principle of innocent until proven guilty of course applies. No one is being shamed just because an investigation has been opened. This is a classic example of government being lobbied by rich corporate interests and the politicians taking their side. Let's just look at the kind of investigations that the FCA is conducting. Misconduct, market abuse, insider trading, money laundering, consumer fraud and scams, and the list continues. These are very serious matters. And let's just look at some of the scandals perpetrated by the financial services industry. This is quite a list of infractions, and these are only the most newsworthy scandals. This is an industry that's prone to ripping people off. It's a brutal industry, highly competitive, which means that it's not uncommon for industry players to get tempted to do anything, to stretch the rules, to make profits. Of course, business is focusing on the damage to profits from an investigation being opened. However, there's the opposite point of view, that consumers will be damaged by continuing to buy from companies that are being investigated for serious offences. The FCA's job is to protect consumers, and it's a careful balance between the various interests. The FCA argues that its new policy to name firms at the onset of investigations will boost transparency and act as a deterrent against misconduct. I think these are really valid points. The FCA also points out that many other regulators do make disclosures at the start of an investigation. The financial services industry is therefore in a privileged position compared to industries covered by other regulators. Predictably, however, the pushback from the financial sector has been robust. Miles Celic, Chief Executive of TheCityUK, said that the proposal introduces a host of new risks for alternative asset managers. As a result, many firms may leave or never enter the UK. The Managed Funds Association, based in Washington, D.C., has said that they have deep concerns with the name and shame proposal. The proposal would fundamentally undermine the economic competitiveness of the UK and jeopardise the UK's position as a global financial centre. Naming a firm before any facts have been established or conclusions have been drawn is unjust, particularly given that a majority of FCA investigations end with no action taken. Any firm FCA publicly names before the conclusion of an investigation would suffer severe harm. These arguments aren't completely without merit, but the financial industry's resistance is a textbook example of how capitalist interests use their influence to shape policies in their favour. Their argument that naming could pointlessly damage a firm's reputation sidesteps a more critical issue, the systemic risk posed by unchecked financial actors whose activities can lead to widespread economic damage. As is clear from these quotes, supporters of the status quo, the maintenance of a cloak over the opening of an investigation, have resorted to threats. They claim that stringent regulatory practices, like those proposed by the FCA, could make the UK less attractive as a global financial hub. This assertion reflects a broader capitalist agenda where regulatory environments are tailored to attract and retain capital, often at the expense of consumer protection and even workers' rights. This stance is emblematic of neoliberal policies that prioritise market freedom over social and economic equity. Of course, it is the case that the announcement of an investigation may harm a company's reputation, even if it is found to be innocent. In this context, it can be noted that in 2023-24, 19% of investigations that were closed resulted in enforcement action being taken. That's only around 1 in 5. Two-thirds of cases, 67%, were closed with no further action. 14% were closed with some other form of action taken. An important point is that the investigations took an average of 43 months. In the case of no further action findings, the average case length was 37 months, 3 years. To be fair, this is a long time for an innocent company to have the issue hanging over their head. However, in the case of all those other regulators, it is considered that it's in the public interest to reveal company names. The same reputation issues exist in all those other cases. Jeremy Hunt says that, "I think it's completely reasonable to name and shame a failing water company, but I think in a financial services context, it's different." Hunt doesn't explain why this is the case. Given the severity of many of the financial scandals, it's hard to see why the financial services industry deserves a privileged position. Of course, we could also point out that just because 67% of the cases ended with no further action doesn't necessarily mean that the companies were innocent. There may not be enough evidence to make a definitive conclusion against a guilty company. This is one reason to have transparency. It increases the prospect of witnesses coming forward and providing evidence. Worse, this statistic may point to the insufficiency of regulatory frameworks to pin down wrongdoing in a complex financial system that's frankly designed to protect its own. After all, the global financial system was bailed out of the 2008 financial crisis rather than being made to fully face up to the consequences of its actions. Ordinary people are still paying for this today. The need for improved transparency was also raised in an official context. In the context of the British Steel pension scandal, the FCA was criticised by the House of Commons Committee of Public Accounts for its light-touch regulatory approach, failing to take swift action and adequately protect consumers. The committee actually called for greater transparency in this context. It said the FCA does not publish lists of firms who are under investigation, so consumers are not aware when searching the FCA register to find firms which have their permission. The FCA must look into whether it should be an option to publish lists of those under investigation where there are significant grounds to believe they are committing serious harm to consumers. This may seem like a boring, mundane regulatory issue, but it potentially has massive impact in terms of giving consumers transparent and accurate information. Of course, Hunt is desperate for the economy to improve, so he takes seriously the threats of businesses leaving or not entering the UK. But the role of regulators and government is to protect markets, protect consumers, in addition to trying to boost the economy. If someone threatens not to invest unless we have weaker consumer protection than would be desirable, I actually would say it's better to take the economic hit than compromise on consumer protection for the sake of profit. Thanks for watching, and I'll see you next time.